Hello, chart watchers, and welcome to this Tuesday, October 9th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, Dow Jones trying to bounce back up off of earlier lows, just like yesterday. We are up 24 points today after being down earlier. The S&P 500 is up nearly 7 points. The NASDAQ bouncing back best of all, currently up 43 points, and the Russell 2000 trying to carve out a bottom as well, up 2.6 points today. The 10-year Treasury yield after being, the bond market was closed yesterday. 10-year Treasury yield today down 1.5 basis points, 3.22%. Still well above that breakout, though, at 3.11%. Volatility index, this is what I'm watching closest today. You can see now, at least temporarily, we have had 3 big reversals in the volatility index over the last 3 days, including today. So unless we see a pickup in volatility later today, it certainly is beginning to look like the worst is behind us here in the near term. Leading the market to the upside today, you can see energy having a nice day, breaking to new highs. 77.78 has been a very tough resistance area for the XLE in 2018. We'll see if we can get through today. XLC, communication services, this area has been getting hit hard so far in October. We did put that long tail in yesterday, though, coming back up, closing near the high, and we are higher today by about almost 0.75%. XLK technology really getting hit the last 3 days, of course, with software and semis under a lot of pressure, but we are seeing a bounce today in technology, also off of recent support. Materials, on the flip side, continuing their downtrend. This is a very problematic. It's been one of the worst performing areas in the market throughout much of this bull market, and rising dollar is certainly not helping there. Industrials weakening, but I do like the action here, holding on to support around 78, bouncing off of it. And then finally, the top performer in the Dow today is Walmart. Walmart put in a nice bullish engulfing candle yesterday after a steady downtrend after its solid earnings back a couple months ago. But it does appear to be breaking a trend line today, and volume is picking up as well. So Walmart looking pretty good today. Erin, how are you doing this fine Tuesday?
I'm doing quite well on this fine Tuesday. How are you doing?
I'm doing just fine. I know your Ducks were home last night. Did they win?
Yes, it was our home opener for the season. And yes, we won in a shootout at the end. It was really exciting, great game. And of course, it's a great game when you finish it on the winning side.
Well, you've done that 3 times now this year, right? 3-0?
I know we're actually undefeated, but you know what, we've got a lot of big guys on the bench right now, and I don't know how long this will last. So
And
we'll see.
not to mention 77 more games or however many more they play.
Yeah, exactly.
It's pretty amazing to me. Hockey always ends in the middle of summer.
Oh, I know. It seems that way, doesn't it?
Oh, it does. It ends in June. I don't understand it, but hey, it is what it is. You got baseball ending in snow, and you got hockey ending in, heat wave. But
Yes.
anyhow, we got a ton to go over today, so I'll let you take it away.
Absolutely. Upcoming schedule. Arthur Hill is going to be with us tomorrow. Bill Shelby will join us on Thursday. And Mary Ellen will be back for What's Hot, What's Not on Friday. So good week still to come. Today's agenda, Tom's going to be starting off with a Q4 review. So that should be very informational for next month and thereafter. Cisco will be our first symbol in the 10 and 10. And finally, I'll finish up with actually a sector rotation scooter report, sort of a little combo. And let's go ahead and get started with some technical news. What's going on out there?
Well, actually, it was very light. There wasn't any economic news of significance out there. We did have the bond market closed yesterday, but we have reopened today. So let's just take a look at what's going on with the 10-year Treasury yield. Here was that steep move off of that rising 20-day test. A lot of things really have turned up here on the 10-year Treasury yield. You can see that over the course of the 4 or 5 months, the PPO was above the center line, below the center line, above the center line, back below. So there was really a lot of indecision going on. It was just consolidation. And that's typical of what you see during consolidation, that PPO or MACD or PMO or whatever momentum oscillator you're following tends to just go sideways. Really, just when you start to think you got something to the upside, then it breaks back down. And one of the keys and one of the clues that you're in sideways action is when your moving averages don't provide support. So when you're simply going back and forth above and below your moving averages, that kind of tells you you're in nowheresville and still looking for a trend to break out. Well, that trend began in September. We had the huge move up here in the 10-year Treasury yield. And this time when we pulled back, notice that rising 20-period moving average held, and we broke back out to new highs. That is the makings of an uptrend. So I see the 10-year Treasury yield continuing to go higher. PPO is as strong as it's been really since back in February when we had this huge move up. So I don't know where we top out on this move in Treasury yields, but I do think we go higher to the downside now. Instead of looking down to 3%, I would be looking at that breakout around 3.11% and the rising 20-day moving average, which is currently at 3.095%. That should provide some support on any pullback. So as if money rotates back into treasuries, that would send the yield down, and I would be looking around 310, 311 to hold as support. Let's keep moving on. We got the 10-year, or actually the S&P 500. I wanted to compare that with the volatility index. And so let me go down here and change this for you. And this goes back the last 3 years. And what I wanted to do is just kind of highlight that on a weekly basis, some of these pullbacks, when we get back and we hit the rising 20-week moving average on the S&P 500, the pullbacks, there's a little bit of volatility, increase in volatility that takes place. And look at this near 20-day test, 20-week test, I should say. In April of 2017, the weekly VIX got up as high as 16. Then we came down in August of 2017, hit that 20-week moving average. Notice the VIX got up to about 16. And then earlier this year, back in June, when we had the selling for a couple of weeks and we went down below the 20-week, but then held it at the end of the week, the VIX got up to about 16. Well, we're right at about 15 and change right now. And of course, earlier yesterday, and then of course last week, we got as high as 17, 18 on that VIX, which on a daily chart I've shown in the past, where 16 to 18 on a daily chart tends to be about where you go when you're in a depth in the midst, I should say, of a bull market. So when you're in a bull market, the VIX tends to go down into the low double digits. You can see throughout 2017, when we basically just kept going higher and higher, we had a couple of spikes on the VIX, but you can see for the most part, we were just down around that 10, 12 level. And that's important because in a bear market, the last two bear markets, the VIX never went below 16. So if you're looking, and I've read so many stories here just over the past couple of days that now we're starting a bear market. And I'm like, really, here we go again. We're starting a bear market because we've had a little profit taking. I think a bear market requires a lot more than just having some profit taking, which we hadn't had in a while. You can see the S&P 500 from the low below 2,700 at the beginning of July. We just had one of our best quarters in the last 4 years. And so I think you got to give the market a little bit of room to the downside here. I would continue to watch that rising 20-week moving average. Let's keep an eye on the VIX. I think we may have just topped on that VIX around 18 and change. If we break out above that and we begin to lose 20-week moving average support, then we got something else we can talk about. But until then, I would view this as nothing more than a little bit of short-term profit taking. I expect to see the market rally again, heading into earnings season. All right, let's take a look at a couple of individual companies. First, PPG. They lowered their Q3 revenue and EPS guidance. You can see a huge move down here, gapping down and potentially closing below support that we saw earlier. I want to bring up this relative chart because this is something that we talk about a lot. This is a group, specialty chemicals, I think, here that had broken out to the upside, was looking really good, has just recently pulled back. But even on that breakout, check out how PPG was doing relative to its peers. It was struggling. It couldn't break out. It was still trying to get through about a 3 or 4 month high, and it was nowhere near the high that it had back in March relative to its peers. And so right before this announcement, they were trading almost at a 52-week low versus their peers. So again, we shouldn't be shocked when you see a stock, and relative to the S&P was doing the same thing. But when you've got a stock in a group that is underperforming, don't be shocked when you see a bad a bad fundamental report come out. That is what the charts are telling us. That's why we do follow technical analysis. Everything that is known is in the chart. And you might say, well, how do you know that there's going to be a warning? Well, analysts are going out there talking to these companies. They have a sense of whether or not they're going to meet their numbers. And unless like Facebook, they just don't tell anyone. And then they're sitting at their 52-week high when they come out and drop a bomb on the market. But here, I think you could see PPG just wasn't acting well technically and on a relative basis. Now we get the bad news. Let's take a look at another one, BLKB. This is another company. They lowered their fiscal year 18 outlook. You take a look now. Here's software. Software has been getting hit pretty hard, and so has BLKB here in October. But on a relative basis, look at the last few months. Software moving higher, BLKB moving lower, and look, right before the warning, they were at a 52-week low relative to their software peers, and had been underperforming the S&P by a pretty wide margin as well, even though they have been in a very strong group. So again, don't be shocked when they come out and lower their guidance. They're not trading well. And then finally, last one I wanted to pull up. This is a little bit of an anomaly. You've got Helen of Troy, which reported their earnings, and I think they came out this morning. Excellent results. $1.98 versus $1.59 expected. The top line, $393.5 million. Market was only expecting $349.2 million. So absolutely blew the numbers out of the water. They raised their guidance, revenue and earnings guidance going forward. And you look at it, they're in the durable household products area of the market, which has been very weak. And yet Helen of Troy relative to the group has been very strong. And despite being part of a really weak group, the Helen of Troy has been outperforming the S&P 500 by a wide margin. Here you can see its peers relative to the S&P 500. So this is one of those kind of strange charts and companies where its group, its peers, not performing very well, but somehow this company continues to produce great results. Did gap up with the news today, came back, pulled back. I think has pretty good support between about 118 and 120. Hit the 50-day moving average, trying to bounce off of it. We'll see how it finishes today, but HELE at a minimum at least, continuing to post some pretty good numbers in an area of the market that has not been performing well. So I know there were a number of upgrades and downgrades today. Erin, why don't you take it away?
All right, let's get started. And indeed, we have quite a few to go over. All right, let's go ahead and we're going to start with our downgrades today. First of all, COHR, Coherent, was downgraded today by Longbow from a buy to a neutral. I have marked off current support for this year at this point, and we're sitting right on top of it. You could see back here, we did get warning from the PMO with a sell signal that things might be starting to head south. And then this really, I think, gave notice when we had that whipsaw back into the PMO sell signal. Right now, I don't see this as a great opportunity. I mean, they just downgraded it as it's hitting this very important support. I'll go and just flip into the weekly chart here, just so we can get an idea how important that particular area of support is. If we lose that, I guess you could come down here into that 100, I guess probably 10, 15, somewhere in there, maybe at these tops. But the most major area of support coming up, I would say, is all the way down here at 80. So be very careful with this one. We are looking at oversold readings on the PMO, but a top below the zero line on this weekly chart gives me pause. All right, international paper. This one was downgraded by BMO Capital from overweight to a market perform. You could see the PMO was already moving lower with its tops, and we had two tops below the signal line on IP, international paper. We're still not oversold as far as the PMO goes, so it could certainly accommodate more downside. I've marked where I figure the next couple areas of support are. And that would be right here at these 2013 tops. This is a weekly chart. And mainly because if you look, we didn't have anything in the past year to give us an idea of a support level on daily charts. So I wanted to go to a weekly. And you could see right here, those 2013 tops, I think, and that hits there with that low in 2016. That would be your next area of support. And that's looking at about $41. And past that, I would go in this area right around $35. So I think there's room for more downside for IP, and it could be a lot of downside. Kroger was downgraded from neutral to a sell by Deutsche Bank. And again, another one sitting on very, very important support. I would say, looking at this declining PPO, and in the thumbnail, you could see the top below the signal line. It was just turning up, and now it's going the opposite direction. My thought is we are going to finally close up this gap that we had show up back in June. So I would expect to at least see that gap close. Now, we could end up moving back down even further and looking at this $23 range here. I suppose you could make a case for this area of the gap that we had previously, but you know, we covered that gap. I'm more interested in the ones that still need to be filled. And there you go with that one. All right, Mylan. This one was also downgraded. Morgan Stanley downgraded it from overweight to equal weight. And as you can see on the daily chart, we have just broken down below some very, very important support. You can see we are still in decline here for the scooter. It's in the basement now at a 5.3 reading. PMO has been heading lower over here, and you can see we had that sell signal early. It looks very similar to the chart we looked at for COHR, coherent. And you've got the OBV in decline here on this decline. Of course, EMA is set up as negatively as possible. So where is our next area of support here for Mylan? Going to the weekly chart, I would say down here at $30. This area is already being broken. You could see again how important $35 was for support. Now I'd be looking at $30. Whirlpool also downgraded today. JP Morgan downgraded it from an outperform to a neutral. And again, with these downgrades, I'm not seeing any bottom fishing opportunities here. I just really am not. Everything here looks like it's ready to, continue lower. It's already been beaten down, but I don't think they're beaten down enough, especially when you see these areas of very important support. This is a weekly chart, guys. That area is now being broken from 2016 and 2014. We haven't seen lows. We haven't seen prices this low since back in 2013 for Whirlpool. They are in a world of hurt right now, I would say. I'm looking at the $95 area as the next area of support, but boy, I could certainly see it moving even further down. The only thing that might curb the problem is that we are seeing a PMO that is in very negative territory and very oversold territory. We have seen those lows back here from 2012, but we haven't seen them since then. So we could see the PMO turning up maybe when we hit that $95 support range, but on the downgrade, I don't see it. I'm going to get to ENSCO shortly because I like ENSCO. And News Corp. This was upgraded. So we're looking at upgrades now. Goldman upgraded News Corp, NWSA, from a neutral to a buy. I think this one looks quite interesting, as we always say, but it is getting ready to hit some major resistance here. On the upgrade, and now you can see also a PMO buy signal in oversold territory. I suspect we will see that area of resistance broken above, and I would look for a move up to that 1475 area. That would be the next area of resistance, but you may want to leave it on the watch list until you get the breakout. But I suspect we will see the breakout. Maybe if you get in it now, I'd maybe set your stop down here at about 1310. But I'd be looking for that move to 1475. I think that's a pretty good risk reward. Scana Corp was upgraded as well today. You can see Mizuho updated it from a neutral to a buy. It's also getting ready to hit some important overhead resistance, but the setup looks great. Look at that scooter moving to the upside. I would expect to see this one break out, but there's resistance lying in wait at $43. So that could pose a problem, but we do need to close that gap, and I suspect we're going to close it. Question will be whether that resistance will hold or not. Walmart also given an upgrade today from a hold to a buy. This one's breaking out today from a declining wedge. So looking good. You can see that we have the PMO turning up here on Walmart. So I'm thinking Walmart's looking pretty good. And if we do see the market continue down, if we continue to see a pullback or corrective move, this is in a good area, I think, for the looking for that move to the upside. Overhead resistance sitting here at about 100, but I could certainly see it coming back up to retest those highs we were seeing back in January. ESV, ENSCO, and I don't want to take too much time here, but flag on it, which I loved. PMO getting a little bit overbought. I had to look at the weekly chart just to make sure. Look at this double bottom on the weekly chart, broken through the confirmation line. I would look for a move up to that 1250 area. So I really liked ESV. So I wanted to show you that. The monthly chart looks even more beautiful in my opinion. The only issue is, again, $10 here now when you look at the monthly chart. So all right, Tom, let's get you going. I know you have some great information to share with us about, I guess, what to expect for Q4 this year.
Yeah, I just want to take a look and just review things. You know, we've gone through a lot heading into the summer. We did a mid-year review, and that was pretty well received. So I thought we'd just update it here a few months later. Many of the same charts. So I'm going to start off with the charts I started off with last time. Let's take a look at the major indices first. And looking at the Dow, I mean, last time we did this was early July. And so I had this level that was in here because this was the reaction high on the Dow that we were looking at from February and March. And so in order to get back and really start to get the Dow going anyway, it was the last one really to get going. But I wanted to see this move through about 25,400. And we finally got that in early August. And you can see since we went through this level convincingly, it's been a straight up move. We went from 25,400 up to 27,000. Hit that. That was a new psychological level as it represented the first time ever hitting 27,000, a round number. And so we've pulled back a little bit from it, but really not that far. 26.5. We're talking about what, maybe 2% off of the recent high. PPO looks good. It did hold centerline support. So we've still got bullish overall momentum, even though we were pulling back in that PPO throughout the first and some of the second quarter. To me, that was not necessarily that bearish. It just meant we couldn't keep up the pace that we had in the fourth quarter of 2017 into early 2018. We were moving straight up. And so as we just began to pull back, of course, the short-term moving averages get hit first. And so you start to slow down in the momentum. But I think it is really important that we've stayed above the center line and started rising again. I think that the momentum looks pretty good here on the Dow into the fourth quarter, and I would expect that we're going to close the year higher than we are now. S&P 500, looking back, this is a 10-year chart, and I think it's pretty clear that we have been in a channel, and we continue to be in this channel. The January, February selling that we saw, I'd kind of marked this down here because we had broken out just above, or actually it was just below the 2,500 level back in the third quarter of 2017. We ran all the way up to above 2,800 and then came down. If you remember those 2 weeks, really panicked selling, and we marked a bottom that was down close to 2,500. So there's your key support as we go forward. I don't think we're going to head back down to that level. I think it's certainly possible because now that is the major level. We've got higher prices. So we got higher highs, higher lows, and we have a higher high. As long as we don't lose that low, we're in good shape. So there's an outside possibility. I think we could go back down to that level, still remain in this uptrend. I don't think it's going to happen, but if we see that VIX pick up and move back through key levels like that 20, 18.5, 19, 20 area, and we start losing 20-week moving averages, then levels like that could come into play. I don't believe it's going to happen, but we have to be aware and ready for just about anything. So we'll continue to monitor that. I suspect that we're going to continue to hold the rising 20-week moving average, which currently is at 28.37. Another 50 points or so to the downside on the S&P, so maybe a couple percent. But again, unless that VIX really picks up, and if that does pick up and break out, I would say make sure you have your stops in play. Because when the volatility is on the rise, a lot of times we can talk about moving averages, trend lines, channels, everything, even price support to some degree, all you want. But many times in a panicked market, technical analysis just simply doesn't work. It's a completely different animal. So always keep an eye on that volatility index. But for now, I think we remain in a nice channel higher on the S&P. The NASDAQ. Now, looking at the NASDAQ, this is just the last 3 years. I did mention back over the summer that we had a negative divergence. We had higher prices, lower PPO, and we did pull back. We didn't go all the way to the 50-week moving average. We certainly didn't get all the way down to the center line, but we did pull back quite a bit from where we were. And then as we moved higher, you can see the PPO beginning to strengthen again. Now it's kind of flattening. We're right around this 20-week moving average. I'd like to see this area hold. So I do think it's pretty important for the NASDAQ to hold its recent low that we saw earlier yesterday. That moved down to, what was it, 76.54. I really don't want to see panic selling and that level be taken out, because here on this chart, if we do close back below the 20-week moving average, it would be the first time since back at the end of March, early April. And that could definitely lead to some more selling, perhaps even back to that June low around 7,400 or so. So let's keep an eye on the 20-week moving average, and let's see if we can turn from here. That's what I'm looking for at this point. I expect the market to head back higher as we approach the quarterly earnings reports that'll be coming out the next couple of weeks, or starting to come out the next couple of weeks. The Russell 2000, I actually went back into the Russell 2000 earlier today when I saw the VIX dropping, the VXN dropping, because the Russell 2000, in my opinion, is the one that's closest to support. And I also believe two things. Number one, the dollar has been strong. I can't exactly explain why small caps have not performed well. But as far as October goes, this is pretty normal for small caps. The first 9 days of October, dating back to 1987, these 9 days, the Russell 2000 has produced an annualized return of minus 65%. Most months, most calendar months, we see bullishness across our major indices. For some reason, small caps, and it's not just this year, it's not just, last few years, this dates back 3 decades. For some reason, the first 9 days of October are weak, especially the 7th, 8th, and 9th. And today is the 9th of October. So we're getting that historical period behind us. We're holding on to support. We got the 50-week moving average right beneath us. And the next 11 days, or actually 12 days, from the 10th of October through the 21st of October, the Russell 2000 has an annualized return of plus 45%. So all of a sudden, it's like the faucet being switched from cold to hot, going from a very cold historical period to a very hot historical period. And it's happening as we're getting close to support. So I like the reward to risk. No guarantees that it holds here, and I'll be prepared to get out pretty quickly if it doesn't. But I do like the Russell 2000 at this level. We had a double top back earlier in 2018, just above 1,600. We broke above it, and we did have one little test here back in May of this area, but now we're testing it again. I know we're below the 20-day moving average, 20-week moving average, which I don't like, but the biggest thing on the chart to me is price support, and so far I think we're holding it here, so I do like the Russell 2000 as we head into the fourth quarter, but we shall see. Let's take a look at the sectors. We'll start with technology. Technology, I'd pointed out the negative divergence earlier in the year. Like the NASDAQ, we didn't get the 50-week test, but we did get quite a bit of a pullback in that PPO. And then as we broke out, we were rising again. Currently, we have rolled over in the PPO, so I do want to hold this 20-week moving average. So far, that has been an excellent entry area going back the last 6 months or so. So the XLK, I'd be watching it closely here. We had that intra-week low beneath the 20-week, but so far we are holding it. Communication services. I think we got a bullish wedge in play. I am a little concerned with internet stocks within this space still, but the overall chart I'm not going to argue with. We had an uptrend. We have been consolidating in this bullish wedge. We have not broken out of it yet, so we may continue to have some weakness, which is kind of what I'm expecting given how internet stocks look right now. But at least recognize the pattern. If we do get a breakout, if we see a big move up through 49 on the XLC and it comes with some increase in volume, then I would be a little bit more bullish on this group. I would begin to think maybe we're going to rally into year end. Consumer discretionary, still a strong area. I know we took a really big beating last week. This week, though, we are trying to hold that 20-week moving average. I think if we pull back the 107.5, 108 area, is going to hold. I don't know if we get back down there, but that was a pretty big level of resistance. That's where we had topped back in January, consolidated for several months, and then made the breakout, and we held the pullback. So I do think 107.5, 108 is great support, but we may hold this 20-week moving average and simply roll from here. Industrials. Industrials, I really like the pattern. We have not cleared the January high, but off of a beautiful uptrend, I see a cup. So here we've got a nice cup. We held a couple of areas of support that I had marked back in June or in July. We were sitting down that level at that point. It held. We rose all the way back up, and I think we've completed this cup, and now we are sideways consolidating in a handle. PPO looks great. If this gets to the 20-week moving average, personally, I would be a buyer of the XLI. Financials, XLF, a lot more consolidation. Both industrials and financials do tend to perform well on a relative basis when rates are rising. So it's a little surprising right now that financials are still quite a bit below January's high when we've got the 10-year Treasury yield breaking out the way it is or has. So I think we're in more consolidation mode still for the financials. No confirmed breakout, although I think some of the bank quarterly reports, there'll be some big ones out on Friday, including JP Morgan. That one will be very interesting because JP Morgan is close to a breakout. So the XLF is going to need some leadership. We're starting to see some from the life insurance group. Be nice to see some breakouts in the banks as well. So keep an eye on JP Morgan. I think Wells Fargo and maybe Citigroup, I think, all report on Friday morning. And we'll see how they perform, not just how they performed in the previous quarter, but what they're saying about the future now that we've seen this breakout in the 10-year Treasury yield. You may see some estimates being raised, just saying. Energy, XLE, here we are right at the 78 level. I think we got a nice bullish pattern into play, by the way, too. We are rising, continuing to put in higher highs, higher lows. So we've got a nice uptrend in play. We pulled back, went a little bit below that 20-week moving average, but since have come back up. We are looking for a breakout. We have not had a weekly close above 78 in quite some time. So let's see if we can get it this week. I think that would be very bullish if we do. Materials. I've talked about materials. This is not my favorite area. You can see that really we're closer to the 2018 lows than we are the highs. I think the one thing that's keeping the materials afloat, you got a couple of pretty good industry groups within the space, but the rising dollar that we've seen really over the past several years is keeping the relative performance of material stocks at bay. So, you know, in a bull market, just about everything goes higher, but some things go up higher much faster and some much slower. I think because of the rising dollar and the effect that that has on many of the areas within materials, I think that is why on a relative basis, materials are not performing well. And not breaking out like many of their sector peers. Watch 54 to about 55.5 or so. That has been key support. That's where we bounced back in April. We're heading back down there again. I know this is not good on a relative basis, but on an absolute basis, this is a key area of support to watch. Healthcare, beautiful. Hard for me to argue much against healthcare, other than the fact it's just overbought. I mean, we saw this back in January, beautiful move in January, but look at the RSI got up over 80 on a weekly basis. We saw it back in June, July of 2017 as it was moving up. You got that weekly RSI goes well above 70. You pull back. We're up there right now. We've got this RSI, weekly RSI. It's currently at 70. It's been as high as about 73, 74 recently. Don't be shocked if it pulls back and kind of gives way to some other sectors that might lead here in the short term. But I believe if you get a pullback here, similar to the August period when we relieved the overbought conditions then, I think we could see a 20-week test, which I think would be very viable. You also have great price support coming in just above 90. Consumer staples. Well, not exactly great relative performance if you look back over the last few years. But what we do see is continuing higher highs and higher lows. And I think as long as the low from the end of 2016 holds, I think the pattern remains in play to go higher. Again, like materials, though, I think your relative strength is the real issue. Investing in this area, you're going to find some winners, but you're also going to find many stocks that underperform on a relative basis. They may go higher, but they probably are not going to go up as high or as fast as the S&P in general. So that's why I would stay away from the group, not because I don't think it's going to go higher. I actually think we're going to go back up and test that January high eventually. I just think on a relative basis, this is not where you want to be. Real estate, I would make the same argument. I'm going to say the same thing about utilities. On a relative basis, we continue to put in higher highs, higher lows, or on an absolute basis. But on a relative basis, I think we're going to continue to see underperformance in the real estate group. We topped back in August. We've pulled back. I think I put this chart in my blog this morning, the daily chart, which shows a declining neckline. So if we go back down below, say, 3140 or so, we're going to be breaking this 2018 uptrend, and we're also going to be breaking a neckline on a topping head and shoulder pattern on the daily chart. So just keep that in mind. Otherwise, I would expect that we're going to see it maybe move back up, try to test the recent high. Utilities, XLU. Here you can see we have been challenging the recent high. I think we're going to struggle here, but with the PPO accelerating to the upside, we did see, you can see with this green arrow, beautiful test of the rising 20-week moving average. So far, so good. I just don't know with this overhead resistance and with 10-year Treasury yield rising, I think it might need another pullback. I would be a little careful with XLU, especially because it's so close to resistance. I would be a seller and see if I could get it back a little bit cheaper. And that's it for the sector. So before I go into this employment, non-farm payroll employment report, I mean, looking back at the sectors, they still look good to me. It's hard for me to get behind bearish thoughts when really not one single sector is bearish. On a relative basis, obviously, you're going to have some that underperform. I'd be careful with materials, consumer staples, utilities, but I'm not seeing relative weakness over a more intermediate term from any of the aggressive areas of the market. I think they've all bounced where they needed to on a relative basis, including both industrials and financials. And so I can't get behind a bearish call at this point in the market. This is just a cumulative employment chart that shows you kind of, you know, when you're going straight up in terms of employment numbers, the market tends to do well. We had a great bull market back in the late 90s when this was going straight higher. When we did pull back finally and we started going lower and we started losing jobs, that was when we had a bear market. 2004, 2004, we started picking up on jobs again. Early 2008, we started rolling over. And then in 2009, we bottomed, late 2009, and then we have been rising ever since. I'm not seeing any signs here yet of weakness. Now, granted, normally the weakness starts and then you kind of see the rolling over. So if the market breaks down again and if the VIX rises and goes up into the 20s, and then the next few months we start to see this roll over, then there's a pretty good chance that we're going to have some issues down the road, but I'm not seeing anything here yet. And speaking of the economy and the strong jobs and all, this is a chart that I show quite frequently here on Market Watchers Live, but you can see that the relative, when you look at the 10-year Treasury yield here in the U.S. relative to Germany, the yield is continuing to rise faster in the U.S. That's what this top chart is showing us. It's taking the 10-year Treasury yield of the U.S. in the U.S., subtracting the German 10-year Treasury yield. So it's a net number. As it rises, it's basically portending a stronger U.S. economy. That means a stronger dollar, and a stronger dollar normally means an outperforming small cap area. Now, what we have seen over the past few months, and I'm a little surprised by it, I'll admit it, is that the Russell 2000 has been underperforming the S&P 500, but it is nearing a major relative support level. Another reason why I went into the Russell 2000, because I think as long as it holds this relative support area and begins to bounce, that's what I'm looking for. I'm looking for outperformance versus the S&P 500. So I think this chart supports my thinking that the dollar is going to continue to rise because the dollar has a very strong positive correlation to the difference in our yields versus Germany's. And as long as our yields keep going up faster, I'm going to be looking for the dollar to continue moving higher. And that's going to should have a positive impact at some point on the small caps. Keep in mind, too, the small caps, after underperforming in the first 10 days or 9 days of October, the small caps tend to start doing very well. And the month of December is by far the best month for small caps. So we're getting closer and closer to that historical period. All right, another look here at the dollar index, just to give you a long-term view and why I'm having problems with materials. Here you can see that since the bottom in 2011, we have been trending higher. On all of our lows on the dollar index continue to move higher. We're holding this trend line beautifully. I think we're going to make another run back toward that 103, 104 area based on what I just showed you with U.S. Treasury yields moving faster to the upside than what we're seeing in Germany and the rest of Europe. And as long as the dollar is moving higher, the CRB index, which is basically commodities, is likely to continue moving lower relative to the S&P 500. This is why, for me, I'm not going to really be that interested in materials. There may be a select stock here or there that I'll trade, but by and large, I'm not going to be looking at materials as long as I believe the dollar is going to go higher. Now, when you look back to the last bull market, we had a dollar that was moving lower, 2002 to 2007. And on a relative basis, with the exception of a couple of brief periods to the downside, for the most part, commodities were rising relative to the S&P. This is a different bull market. Not every bull market comes with a falling dollar. Not every bull market comes with a rising dollar. You can have bull markets with either one. But when you have a rising dollar, it definitely changes the areas where you want to be considering investing. Look at the dollar and gold. Same thing, same chart here on the top. Here's dollar. When we bottomed in 2011, started rising, we topped in gold and started dropping. Now, we haven't broken out to the new high here, and we haven't broken out to a new low here on gold. But what we have done is, while the dollar has been in this uptrend, look at the relative strength of gold relative to the S&P 500. We are down at new lows. We are down at relative lows that we had not seen since back in even 2005. It's been 13 years. Why do I not want to get behind gold? I think this chart says it all. I mean, as long as you've got an uptrending dollar. Now, if the dollar comes back down and I'm wrong and it breaks support, it breaks the trend line, then yes, I think that's the time to be considering gold, because long history tells us that there is a pretty strong inverse or reverse correlation between dollar and gold. Dollar goes up, gold tends to go down, and I would not fight that. So you can see the relative strength here of gold, not good. If I'm trying to outperform the S&P 500, good luck doing it with gold. I can't do it with gold, because if you're looking at the relative strength outside of maybe a 3-month period here back at the beginning of 2016, it's been almost straight down. How do you outperform the S&P 500 investing in something that's been such a poor relative performer? So again, it's not that I'm always going to be a perma bear for gold. I'm just not going to like it as long as I think the dollar remains in an uptrend. All right, XLY, XLP, one of my favorite ratios, just tells us how consumer stocks are doing relative to one another. When the economy is strengthening, we should see consumer discretionary stocks doing better than consumer staples. Because when the economy strengthens, I don't know about you, but I don't go out and buy more soap. But I might go out and buy more drinks at Starbucks, or I might go out and buy another car, or I might go out and even buy a house, although with rates rising, that's maybe not a good example right now. But how about retail? How about going out and just buying some new clothes or new gadgets? All of those things, are you're more likely to do in during an economy that's strengthening. And so if you look, there's a very strong correlation. You can just see it here from the chart between the ratio of consumer discretionary to consumer staple stocks and what the S&P 500 does. When the XLY, XLP ratio is generally uptrending, so is the S&P 500. And when it's downtrending, so is the S&P 500. You can see that on this chart, I think, pretty clearly. So right now, the XLY, XLP just exploded in 2018 to the upside. And it's telling us the economy is strong and likely to strengthen. And so this is not an environment that I believe we're going to get a bear market to start. Transports versus utilities for the exact same reasons. Transports tend to do very well in a strengthening economy. Strengthening economy tends to send interest rates higher, which makes the dividend yields on utilities less attractive. So this ratio also, although it can be quite volatile, I think if you're looking at it for the most part, there's a pretty decent correlation between the direction of transports relative to utilities and the direction of the S&P 500. And if you look back over the last 2 years, we are continuing to put in higher highs and higher lows on the transport versus utility ratio. I think that's bullish for the S&P as well. Now I'm going to talk about a few individual stocks on the Dow Jones just to wrap up that I think look interesting from a long-term perspective. Caterpillar, this is a weekly chart going back the last 3 years. Nice top in January. I see an inverse head and shoulder pattern. Left shoulder, neckline, a head goes down a little bit lower, come back up. We just put in the right side of the neckline. We're pulling back. I think Caterpillar is going to break out above that 160 level, and that would measure up to probably about 190 or so based on the measurement here. Disney I really like. And the reason I love stocks or indexes that base for long periods of time and then break out. We have seen Disney try to get through 115 on multiple occasions over the past 3.5 years. Hasn't been able to do it. Just had a false breakout a couple of months ago. Pulled back, hit that rising 20-week moving average, and right back up she goes. I think this is a breakout on Disney. Maybe you wait and see if we take out the highs from the last 2 months, but it looks to me like this is the real deal. I think Disney, equal highs, rising lows, you could call it an ascending triangle. I think this one looks really good. I would expect Disney to be a great performer into the fourth quarter and especially in 2019. J&J, beautiful uptrend. Looks to me like we're still trying to put in the right side of this cup. So 145 would be a little short-term resistance, but this is a continuation pattern off of a long-term uptrend. So J&J may have to struggle a little bit, kind of put in a handle, but I think eventually, I think this is another one that's probably setting up really well for 2019. JP Morgan mentioned they're coming out with their earnings later this week. This does not look like the bank index. JP Morgan's on the verge of a breakout, one of the best performers, certainly among the large money center banks. I think JP Morgan is kind of in a class of its own. And depending on what happens with its earnings and its forecast, we could be looking at JP Morgan breaking out sooner rather than later. And the last one I have is United Technologies. UTX, United Technologies just broke out. And this one's actually pulled back about $8, $9 from that high around 145. And the breakout level here, uptrend, cup, handle, breakout. And now we're pulling back to test that area along with the rising 20-week moving average. I think United Technologies from current price down to 133 is a bargain. And I look for it to break out to new highs probably sooner rather than later. I think the chart looks good here. So that's what I had for today's workshop. So let's go quickly through the summary slide. Talk about, that's basically what I went over, the major indices, the sectors, economic data, and some of those charts, dollar and gold, relative ratios. I threw in a few bonus stocks on the Dow. And now, why don't we pull up that poll? Because I'm not really worried about too much about the market. I don't worry too much about news. And I really wanted to see what everyone is thinking about. The number one is the one that I would have picked. Because there are a lot of breadth indicators that are showing that fewer companies are participating in the rally. I've seen that before, though, and then the market breaks out, and then that number comes up. To me, that's a very secondary indicator. That is not a primary indicator for me. But I put that in there because I wanted to see how many of you maybe are following that, because we are seeing some deterioration in some of those breadth indicators. So that would be my number one as well. Prospects of higher interest rates. I tell you, I saw an article today on CNBC.com. I'd gone in there and looked, and I think it was an analyst or maybe the chief market strategist from Sandler O'Neill. And he said that the market was going to pull back probably 8% because of higher interest rates. And I just looked at that and I'm like, okay, I know this guy is probably a brilliant man, but does he not follow technical analysis? Because higher interest rates in one sense, it means money is rotating away from treasuries, the bond market. That's what creates the higher interest rates, the sellers in those markets. And many times it's because of a strengthening economy where you want to be in stocks. And I've shown charts, excuse me. I don't know. You have comments about that, Erin? All right.
Yes, I am here. Sorry about that. I got to get my mute button going. You know, for me, I put something else because I'm kind of looking at the sector rotation, and some of the sector rotation, which I'm actually going to talk about in the final segment. I just don't like some of it, but I was very encouraged, I guess I would say, by the XLY relative chart, the XLY XLP chart that you showed that did assuage some of my concerns, but that's really what I watch for as far as you know, the market. That's one of the first things I look for to see, you know, where we're going. Is it bad? Is it good based on which sectors are leading?
I would agree with you, but for me, it's which sectors are leading when we're moving higher, not when we're moving lower. Because when we're moving lower, money tends to rotate towards defense. I mean, it's just, you know, people are start to panic. I mean, we're seeing it. We've seen it recently with software stocks, semiconductors, internet, some of the groups that have been leading for a while. You get a pullback, and nobody's used to these pullbacks. Or I shouldn't say nobody's used to them, but you know what I mean. I mean, just seem to go up and they never pull back. And then they pull back and everyone panics. It's like, oh my gosh, you know, software is down. Well, it looks pretty darn good on a long-term chart if you pull it up. You know, you're going to get these pullbacks from time to time. But what bothers me is when you start to see the market breaking out and leadership in those breakouts moving into defensive areas. That, you know, from my work, that's what I worry about. I don't worry so much like what we've seen here over the last few weeks, because I do think that it's normal for the market to pull back. When it pulls back, to see money rotate out of some of the more aggressive areas. So little.
Well, I'll be talking about it, but I have to say, I mean, I think in this rally going to the upside, I still see some problems when I look at the sector summary over the past month to 3 months. But I'll talk about that at the end. So
it's good to have differing views too, and I think the listeners and everybody appreciates that. And I'm sure not everybody agrees with me, and not everybody agrees with you. So it's always a good thing to have two sides of, you know, taking a look at it from both sides, and then you can kind of decide what you believe in, because everybody's got to make their own choices.
All right, take a little bit of what everybody says.
Well, I think I did. Fortunately, I think in the poll we covered most everything, or at least maybe no one was thinking about the other.
Oh, there was somebody who did say you didn't put in there, I don't have a fear regarding the U.S. stock market. So I told them they needed to put their vote under something else.
Oh, yeah.
Yeah, somebody out there was feeling still pretty bullish. So, you know, hey.
I just assumed everybody has a fear. I mean, I can always look at the market and say, this doesn't look good.
Yeah, there's always something, right?
Yeah, yeah. Or even in a bear market and say, this doesn't look bad. There's always something. You can, if you're a perma bull or a perma bear, you can always find something to support your argument, no doubt.
Yep. I'm always looking for that one or two things that aren't confirming. Yeah. And that way you kind of can say, well, that's not quite doing what it needs to do, and maybe I don't want to go forward. Yeah. So have to listen to that stuff.
All right, well, let's move on to the 10 and 10. I'm gonna be listening later for your sector rotations to get your thoughts there. But
there you go. There you go. So all right, so here is our RRG. Let's go ahead and look at the sectors first. Here we go. So really you know, when you start seeing a lot of people looking at energy stocks, that I think that's very interesting. Of course, technology always seems to be a favorite as far as our requests, but energy definitely winning the battle today, I would say. I guess it's tied with technology. So, all right, well, let's get started. I think our first one was from technology, and that was Cisco.
Yeah, I like Cisco. I just think in the short term, it may have some issues. It's been pulling back. It's below its 20-day moving average. Keeps putting in these lower highs each day, as you can see. The problem I'm seeing is that with its recent high, you can see the PPO is much lower. So we did run into this once before back in March, where we had the higher prices, the lower PPO, and you can see how it led to some selling for a period of time. But the overall trend remained intact. We consolidated, and then we broke back out again. I think the long term still looks good here on this chart. I just think short term, would I be shocked if we move back down to this 46 area, maybe even 44.5 to 45? I wouldn't be shocked. In fact, I think 46 would actually be a pretty good entry point. Bring that PPO back down closer to the center line. Then we would be down at 46. We'd be down, what, roughly 6% maybe from the high. That'd be a pretty decent little pullback. So I like Cisco. I just think it's maybe a little bit early to pull the trigger at this point.
All right. And the most popular in the chat room, kind of in that same area there, Intel.
Yeah, Intel, I like the fact that it held the 20-day moving average, but it's moving lower again today. And I know I'm going to come right back to this chart. I just want to see what the semis are doing today, because semis are at a major support level right here at 33.50. We actually closed just below it yesterday, and we continue to move a little lower here. This, and even on an intraday basis, 3,300 is support. So this is kind of a zone that is worth keeping an eye on, because it's been holding for the last few months. If we break down here, Intel has not been a good performer. As we go back and we take a look at Intel, I'm going to pull it up on a relative chart. But you can see Intel relative to the semiconductors has started to turn back up, but it's been in a longer term downtrend. So if the group breaks down and we start to see relative underperformance by Intel again, and that could happen if we don't hold this 20-day moving average, I'd keep a tight stop here because of the performance of the group, which has been weak. It's at support. If that breaks down and Intel starts to roll back over again here, I would not be a fan. That's about what I have. Let me annotate, though, and just kind of highlight, because we did see the PPO strengthen. I don't show that here on this chart, but there is a strengthening PPO on the last high. We broke this downtrend. Did put in a shooting star candle at the top. That's only a short-term reversing candle. I would be looking for this 20-day to hold, and it's right on the cusp right now. So I'd be careful with Intel.
Okay. Let's see the third one. This has been requested quite a few times, so I've figured it's time to do it. TGODF, and that is, what is the name of that one again?
The Green Organic Dutchman.
Green Organic Dutchman, yes.
Let's just go ahead and put it up on a different chart. I don't need all that time. Well, you can see the tops were marked by these huge long tails. That's always that is one of the most important things as a short-term trader. When you see these long tails, this was in breakout territory. So who's going to sell other than maybe market makers who maybe were getting out of shares for an well, probably not an institutional client for a small stock like this. But it's probably only a few market makers on a small company like this, and it is on the over-the-counter market there. You just got to be careful when you get these big reversals to the upside, because normally that does lead to selling. We saw it back in June. You saw it again just recently. I would be watching the recent lows down around 465 or so. And the reason being, there have been multiple tops and recent bottoms right at about this level. We could go back to July, where we topped at about 460, 465, did it again in August. Look at the volume pickup as we went through, had a big reversal, came back down and tested it, just tested it again off the downtrend. So clearly that is the level to the downside. I'd say to the upside, watch about 690 or so. Pretty wide range, but that is the range I would use for now.
Okay, let's see here. Next one up, how about Bank of America in the financial space?
Well, they're going to, they're going to roll with some of these other banks with the earnings coming up this week. And with the 10-year Treasury yield, the yield curve, all of those things matter with these banks. I really want to hold that recent low, though, which went below this pullback in July. Let me just annotate here. I'm going to draw that support line from that low back in July right here. And when we went down, we actually went just below it about a week ago, a little over a week ago, and then rallied from there. And now we're kind of trending back down. I would have a fairly tight stop. I think if we move intraday below 29.25, certainly maybe give it a little bit more room, maybe 29.15. Then I think we have a shot on Bank of America to go all the way back down to 27.50, which I would not want to ride it back down that far. We got back through the 20 and quickly reversed. That's a dark cloud cover reversing candle. We are moving lower off of it. So I think we're between let's call it 29 and a quarter and 30.75. And that's the short-term range. I would trade that range until it breaks one way or the other.
All right. Next one is an ETF for you, the China Large Cap ETF, FXI.
Yeah, I'm not a fan of China. It's just been underperforming the S&P 500 for a long, long time. And so I'm just not really seeing anything other than, if you're trying to trade this as a support, short-term bounce off of support, I guess I could see that because you are down close to where we have bounced the past 2 months. August low down near 40, then we had a September low near 40, and here we are right now below 40.50, getting closer to that support level. Recent resistance, though, has been up around 43.50 for the most part. So that's the trading range. If I got in, I'd just have a tight stop. If it breaks down again, I'd be out.
Okay. Next one is RDC, Rowan Companies. Oh, interesting breakout from a flag.
Yeah, it looks really good. PPO looks good. Breakout. I'm going to take this one back. Let's take a look at the relative chart here. Yeah, I love these long bases like this, and then the breakout. Look at the volume coming in. This reeks to me of accumulation on the stock, so I really like it. The only question is where you want to get in because it has gone up quite a bit. But there was the breakout. If at some point you can see the tops pretty clearly, just around 17 and a quarter, then we get the breakout, and look at that volume that picks up on the breakout. This is classic technical analysis, really TA 101, where we consolidate for a while, and then when we break out, we get the volume to confirm it to the upside. Flag pattern, as you mentioned, Erin, next to it, and then a breakout of that as well. So still very bullish. I think your short-term support now is going to be that latest breakout, which is about 1930 or so. So that would be the first area on a pullback, along with that rising 20-day, which is moving up. But I think eventually what's going to happen is we'll probably see at some point, might be a few weeks away, we'll see a negative divergence arise, probably come back down, and as the 50-day comes up, perhaps be able to get this back down close to that 17 and a quarter level. But I think short term, I would not be looking for it to go back down that low. I would maybe look for maybe 19 and a quarter or so as support.
All right, let's look at a consumer staple, the only one requested, GNC Holdings. I have a really ugly PMO.
Well, here's the deal. I like the group that it's in, which is the food group. It has been underperforming, though, for a long time. It's just starting to show some relative strength. So what that tells me is I don't want to see a 20-day breakdown. If this thing is starting to strengthen, then I'm going to have a very tight leash on it. It needs to get back through about 440. That was the tail that we saw back in June. And it needs to hold that rising 20-day moving average. I mean, these types of stocks, I don't like bottom fishing. So I normally give them tight leashes. And if we go back down and close below the 20-day, I'd probably be right back out of it. What I'd like to see, though, is the 20-day hold and get some volume to confirm a breakout above 440.
Okay, let's see. Next one, eBay.
Yeah, I was having a great day earlier. I think it was today. But I'll pull that up one sec. All right, eBay. Yeah, coming off this bottom. Now we'll see. Have to see whether, excuse me, we'll have to see whether it holds into the close. But I think there are a couple of levels you have to really watch here on eBay. It's been an underperformer for a long time. And it's in a space that has been doing pretty well. So I would just say, maybe I need to see a little bit more. I certainly wouldn't just jump on it for one day. But here was the big gap down. Look at that volume, biggest volume on the chart. Over 50 million shares. Started with selling at 35 and a quarter, let's say. We went down to 32 and change, went back up to that 35 and a quarter area, failed, went down to a new low. I think we've got to get through 35 and a quarter. So yes, short term, I like what's going on here today. I think there's more work to do on the chart, though.
All right, let's see. How about we try ENSG?
All right, ENSG.
Ensign Group.
I like the sideways consolidation. It's in a very strong group. Now, while it's been consolidating, I don't have to look down. I can tell you it's already been underperforming recently because the groups continue to go up. But keep in mind, this stock went from what, $22 to $40 in 4 months. So it needs some time to consolidate. A breakout out of this base would be very bullish. We're starting to see more relative strength again recently. Watch for that breakout. I'll annotate the relative, or not the relative, but the rectangular consolidation really that we've been seeing here for the past 3-4 months between 35 and 40. But we are starting to show some strength. Need more volume. So I'd probably, as a short-term trader, be a seller at 40 until I get that breakout with volume, especially with the light volume. But what you're looking for here is no doubt volume picking up and a close above 40.
All right. Our final symbol will be for Akamai, AKAM.
All right, Akamai, well, it's broken down below some key support levels. I think that is a problem. You can see that it's part of the internet group. I've been talking about internet stocks. This is not an area of the market that I'm comfortable with right now. And so it's a stock that's broken down in a group that's broken down. And that to me is just simply a void. We had multiple support and tests down around 70, 70 and a half. Then we had a breakout right here across these tops. Back in March, we went back and tested that. So I thought that this was a pretty big area of support. We lost it with the volume picking up. Now, and I'm not somebody who would short because I still am trying to play on the long side in the bull market. But if I were to short, this kind of a stock is the one I would short if we were truly in a bear market, where you break down, you got the declining 20-day moving average. If we could move back up into that range, if I owned it, I would be selling it. And if I was looking for short candidates, that's where solid reward to risk would reside. So I'm not a fan of Akamai. I'm not a fan of the internets. I would hold off for now on these stocks.
All right. That completes the 10 and 10. Here are the symbols that Tom just annotated. I will have all of those charts exactly as they were annotated in the Market Watchers Live chart list. And you will find the link to that at the top of the Market Watchers blog on the blogs page at stockcharts.com. All right, time for our final market update. Let's see what has been going on since we last left. All right. So as you can see, markets, it's been a little bit of a choppy day, to be honest. We're now starting to see the markets falling lower. We had a bit of a pop here, 2 chances to try and get over those tops that we had earlier for the Dow, and really you can see similar setup here for the S&P, and we failed and now are coming back down yet again into negative territory. The Dow is down just over 87 points. The S&P is down just a little bit over 0.25%. NASDAQ is now just reaching negative territory. It spent the majority of the day to the upside. We can see S&P 100 in the last 10-20 minutes has also moved into negative territory. S&P 400, Russell 2000, both dropping pretty steadily since they hit their intraday highs and look like you're getting ready to go down and test the lows we saw on Friday and Monday. The TSX looking similar to a lot of the other indexes we've seen, only we've got a gap down and mostly consolidation here. Treasury yields, we did have the bond market closed yesterday, which is why we have a flat line right there. But we can see Treasury yields are moving lower, currently reading 3.208%. UUP, nice big gap up in the morning here, but we have been pulling back on the dollar all day long. Looks like we may have found our area of consolidation and maybe stopping point for the day for UUP. We'll have to see. It is looking like it's starting to consolidate. Gold, GLD, is mostly unchanged. It did have a bit of a drop in the morning, not quite what we saw as far as an opposite of the big jump for the dollar. Now consolidating sideways. Have to see if it can get back up into positive territory, but right now down 13 cents. TLT, big gap up and now heading higher. I continue to be very bearish on bonds, but definitely TLT having a good day today. USO is up on the day a little over 0.75%. And finally, I just wanted to show you very quickly my very short-term chart on the VIX inverted scale. You can see that we are now puncturing the bottom of those Bollinger Bands. I've been waiting to see the rally pop off of this, and we've yet to see it. Yesterday, I would have, we had some upside here for the advanced decline volume and just the breadth. And you can see we had those, all those very similar to before, those red bars going to the downside. So I would have expected to see that rally pop, but we didn't quite get it. We're still, like I said, managing to stay down here at the bottom of this Bollinger Band. I would still start to look for some upside, even if it's just for the day or the morning. So, maybe this morning's rally is going to count, but I still think we'll see higher prices over the next day or two, eventually here, if we can see that VIX get back up into the Bollinger Bands. All right, that's all I had. Tom, would you like to add, please, to something?
Yeah. First, I just want to pull up the NASDAQ 100 components. So this is a summary listing, and I've got it sorted by percentage change. So you can see the two big leaders in the NASDAQ 100 today are Tesla and eBay. Now, eBay, we already talked about the fact that that chart still has got some work to do. Here's Tesla, which is also, look at the 5 days preceding today, straight down from about 315 down to about 250 before we're seeing a little bit of a pop. So the two leaders in the NASDAQ are really stocks that are still not looking very good technically. And when I look across, I see healthcare certainly sprinkled in here along with some of the other consumer discretionary stocks. But one of the reasons why we're seeing the NASDAQ underperform lately, I pulled up the S&P 500 components and look at what is across the top. It's almost all energy. And when you take a look at the XLE, since the early September period, you can see the XLE has been moving straight up. It's been one of the strongest areas of the market. And when you look at the NASDAQ and you look at the sectors and you go down, there are no energy stocks in the NASDAQ 100. So this is one of the reasons why we are seeing such a divergence between performance between the NASDAQ 100 especially and what we're seeing with the S&P 500 and the Dow. There's no representation on the NASDAQ 100 within energy, and it's been one of the strongest areas. So I just wanted to point that out. If energy breaks out, that's going to be great for the S&P 500. But if it does struggle to get through the 78 level, it could lead to a little bit more rotation back toward NASDAQ stocks. I think we got our final segment coming up, sector rotation. I've been waiting patiently, Erin. What do you got?
You want to see what I have to say? Okay, well, let's get started here. I want to start, as I usually do, with the sector rotation diagram that I have. I think it's really gives you a good picture about what I'm concerned about right now. This is based on the economic cycle, but I also consider it similar to what's going on in the market if it's contracting or expanding as far as higher prices, lower prices. So what we see, obviously, you were talking about cyclicals, technology. Those are where you want to see, and transportation even. You want to see this area starting to improve and be the stronger leaders, because that's where you're going to get started into your next run. But what's been going on right now is, and concerning me, is energy being such a big performer and healthcare. Those two have really been leading the market. Now, granted, materials has been, dying on the vine, industrials, same thing. But this is where we're seeing the strength. And this is, yes, late expansion, but now I'm a little bit worried that we're going to start moving toward this early contraction. And let's look, and here's why. So let's look at the sector summary. And you can get to this just from the home page in the report section over on the left. But I wanted to look at the sector summary. So this is just today, what's going on today, which ones are the strongest and which ones are hurting right now. Obviously, like I said, materials, industrials, these are the ones that are lagging. This is for today. But what I wanted to look at more so was over the past week, the past month, and the past 3 months, and see what you think, what you see. All right, so right now, here you go. For the last week, we've seen utilities, financials, and energy. So let's look at that little diagram here. Let me go grab that. All right. So what has been leading in the last week? Well, we've seen financials starting to come through, and like I said, utilities. So in a very, very short-term time period, over the last week, certainly seeing the weakness. The next thing we want to start seeing is the cyclicals and technology to start to wake up. Now, this is a very short term, right? Because we're only looking at 1 week. Well, let's look at what we've had over the past month for sector rotation. And as you mentioned, and I thought that was an excellent point, Tom, about the fact that there aren't energy stocks in the S&P 100, so you do get a bit of a skew, similar to the NASDAQ, right? We get a skew towards technology just by the membership there, but I thought that was very interesting. So what do we see as leading? Energy and healthcare are the two, and that's what I was talking about that's got me a little bit concerned. And again, there's your diagram. So energy and healthcare right here, late expansion. So we're coming off of that nice move over the last month. We have, let's look at the S&P if we want to get a quick peek here. I'll give you my S&P chart. And let's look at it over the last month. All right, so over the last month, as you can see, we've been in a bit of we had that little bit of rally, but we've started to make that downturn. So again, not surprising to see the leadership when you look at what's been happening to the market and that breakdown from that ascending wedge, that rising wedge. Holding that support though, I think that is positive. All right, so let's get back to our sector summary. So that's over the past month. What are we seeing for the past 3 months? Healthcare, industrials, and utilities. Again, now you're still seeing, healthcare near the top and industrial. So let's go ahead and look at that diagram again to get a picture. And again, healthcare leading. Now we see utilities back here and industrials. So we have a little bit of a mix here over the past 3 months. But again, healthcare, and we know energy has done quite well. It was already doing well in the past 3 months. It's just when you made the comparison, not quite as well as the utilities and healthcare, or industrials and healthcare. So those were sort of my concerns about sector rotation and what's going on. Just looking at in the intermediate term, the past month, in the very short term, in the past week, what has been leading. And, the energy clearly has been the space to be in. So now what I wanted to do was show you the sector RRG. So let's get a picture, and this is an intermediate term picture. So we're looking at 1 year over weekly for the RRG. Read about RRGs to get more information so that you can have a better idea of what's going on here. But one of the things I did want to point out that I think is a good sign that we might be getting ready to come out of, that decline we're in right now over the past month. And that is, even though we're seeing the weakening in XLY, the consumer discretionary, and in technology, we're finally starting to see them. They're not going in that southwest direction, which is what you really don't want to see. You want to see northeast. And we can see that they're trying to turn over, and actually we'll zoom in on them a little bit more. You can see they're trying to make a turn. And, at least XLK is moving north. And, so those are some of the things that you can look at. So I think that we are starting to see a little bit of an improvement. But, again, XLE is still in lagging, but it's been turning that curl back to the upside too. If you look at the daily version, here we are. You can see in the very short term what's been going on. Staples, utilities, energy has been leading, healthcare. These are all in the leading category. So in the shorter term picture, like I was talking about, looking at that sector rotation, we've got leadership in the wrong places. So what I'll be watching is, like we were saying on this RRG, I'm going to be watching where XLK and XLY start to go. They're starting to move their way back around, and that's good for the intermediate term. All right, so I wanted to show you one other thing, and that's, once you find that sector that you're interested in, let's go back to the dashboard. And that way I can start you from the start. So I'm going to look for stocks. I want to find them in a strong sector but honestly, not too strong. I want to see something that's starting to turn around and starting to do better, or that has a sort of a mid-rank scooter is what I'm going to look for. So I'm going to just go by scooter value, not by the percent change right now. And where do I want to go look? I want to look at higher ranked scooters, but in a sector where I am seeing some improvement. So when we looked at that RRG, we did see that technology and cyclicals were starting to improve, but I'm still not completely satisfied with that area of the market. It is turning around. We just haven't quite gotten there. I don't want to search on that. Let's go ahead and, energy has been so strong. Healthcare has been so strong. I want to go ahead and look at the industrial sector. The Dow has been very strong in comparison relatively as far as my decision point signals go. So I'm going to look at the industrial sector. Now, of course, you've got all of the industries, and I could go down and pick one of these industry groups based on what they've been doing over the past week or month. But what I want to do is I'm picking a sector. I'm just going to scan on that sector and find the stocks that meet the kind of criterion that I usually look for. So what I decided to do is I decided I'd start a new scan just to make this easier for everybody if you're getting ready to go in and do your own scan. I just wanted to show you it's really not that hard to come up with your own. So I'm going to take all of this volume and type out of here, because what I'm going to look for is in one of those sectors. Okay, I think we said we'd look at industrials. Let's go ahead and look at industrials. So I want to add that it's in the industrial sector. So that's all I need there. But I want to have one that's got a rising, I want the 50-day EMA over my 200-day EMA. So I'm just going to add that in here. And that's my EMA. I want the 50, yes. And I want it to be greater than the 200-day. So I'm just going to copy that. And we'll put in 200. And I would like a rising PMO. So I'm going to go down and add that as well. PMO line. I just want it to be rising in comparison to yesterday. So I'm going to take this, move this up here a little bit so you can see it better. So I want the PMO reading to be greater than yesterday's PMO reading. So it's going to be just pretty much the same thing here, only I'm going to put in front of it yesterday's PMO line. So basically, I just want it to be rising for one day. Let's just see what we get from that. Okay, and we got 57. All right, I'm gonna, I think I'm gonna go ahead and make it a little bit smaller for myself. Let's go ahead and add that the 20 has to be, the 20-day EMA needs to be above the 50-day EMA. So we'll just change that. Check my syntax. I believe I'm in good shape. Yep. So let's see how this ended up changing our scan results. Now we're down to 40. That's manageable. I might go ahead and pick, I could go back to one of my older scans or the scans that I like. I could, from my focus PMO scan, I can grab, let's grab this one. It'll tell me that it's been rising for 2 days. So we'll just add that in there too. All right, and run that scan. 33. So we're getting better. I'm not going to go through, really, we're a little bit low on time, but I'll give you just a quick peek at what we're looking at right now into a candle glance, because that's what I usually do. So I grabbed all those and I'm going to look at them in candle glance. And I think most of you know how I sift through my scans. I think that particular workshop has been running lately on Stock Charts TV. You want to take a peek at that. But what I'm going to look for, I already know that the PMO has been rising for 2 days, but I want to see something interesting coming through here. I could, set up the volume scan part of it, maybe lose a couple of these really low price stocks, some of these that probably have some lower volume. Let's see, that one looks interesting. It's a really low volume stock, but just for giving you perspective here, this is CMRE/PC. So, this is a pretty obscure little stock here. But what I liked when I saw that in the results was I had this declining tops trend line and a small breakout with the PMO that's just turning up. So let's see if we can find something similar to that with a stock that we might be interested in actually purchasing that's a little bit more well known here. Okay, that looks a little bit interesting. I think this is pretty low volume as well, but you can see again, we've got the PMO turning up. We have it breaking out from a consolidation zone. So I think that one looks interesting, HURN. All right, there we go, GNRC. Generac Holdings. I think this one looks interesting for the same reasons as that first one. We have that declining tops trend line. We have a breakout. Notice also the 5-day EMA is just crossing above the 20-day EMA. That's a short-term trend model buy signal as far as the decision point indicators go. And again, there's your scoop on the PMO. It is starting to turn up. We already have a pretty strong scooter. So relatively speaking, this one is doing pretty well amongst its peers. And you can see OBV reading is getting ready to be higher than that previous top. And I think that would be a positive as well. So I think that one looked pretty interesting. Let's see if there's just one more here to give you. All right, this one, Trinity Industries, looks interesting to me. Possible flag formation. Possible. We have rising bottoms on the PMO. And in fact, that on that rally, we got a bottom above the signal line, which I always like. We still are not overbought as far as the PMO. We have got a scooter that's moved up, back up into the hot zone. And like I said, possible flags. So this one looks interesting. Maybe move that to a weekly. And then I think we should just close this out. All right, I think loosely, you could have said that that one had an ascending triangle, but anyway, those are the types of things you want to look for. Here's what I kind of went over. I think those last couple symbols did look pretty interesting, maybe to add a watch list. So what did you think? You waited with bated breath, Tom.
Well, I will say,
did I make a good case?
Yeah. Yes.
You're muted.
No, I'm not. Hello.
Well, okay. Let's go ahead and get ready here to close the show.
Hello.
All right. We already went over that poll. I'm not sure what happened to Tom here, but that's quite all right. It's been a great show. Tom, I really appreciated your Q4 summary. You guys want to make sure you check out the Market Watchers Live recap. I will be putting in the charts that Tom did just go over. So that sounds great.
Can you hear me, Erin?
Oh, everybody's saying that they hear you, Tom. I just don't hear you.
I'll go ahead and finish.
I'll let you take it away.
Yeah, I'll go ahead and finish this up. The only thing I was going to add is that the XLU for utilities does tend to outperform. Its best month on a relative basis is the month of September. So that outperformance that we've seen of late is really actually very typical of what we tend to see in September anyway. So anyhow, I still believe the market's in good shape, but short term, we'll see. I do want to thank everybody for stopping by today. Please remember to complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.